The joy of the HGS is that you have to submit an abstract something like 45 days before the bulletin comes out, and then the bulletin comes out a couple of weeks before you actually give your talk. And by then, so much has happened that, I've preserved a little piece of what I was planning to talk about 2.5 months ago. So the years, not decades, proven reserves and the shale revolution is still part of it. The apparent end of the beautiful story is more to the point, and it would be very difficult, for me at least, to talk to a group like this without sharing some of my thoughts about the current fun that we're having with the fall in oil prices. And hopefully I'll be able to weave these all together in a message that kind of makes sense. My co-author, at least on the part that I agreed to speak on, is Ray Leonard, who's the CEO of Hyperdynamics. Ray and I have been collaborating for quite some time on originally sort of global gas issues and more recently on global oil issues. Ray's not here tonight because he's in Moscow. He's part of the AAPG Visiting Geoscience program, and he gave the international version of this talk in Dubai a little bit earlier this week. So final introductory comment. I'm going to dedicate my talk tonight to Bill Bishop, who we lost a few months ago, a good friend to the Society and many of us here, and he'll be missed. The reality of years, not decades, of shale gas and tight oil. Shale gas, shale plays have added years, and for that we're grateful, but not decades to domestic oil and gas supply. We call the oil and gas that we produce from these formations unconventional. That's a euphemism for expensive, and that's actually an important point, because where we're at right now, and I think that Mr. Al-Naimi would be the first to point out, is you guys have the expensive oil and we've got the cheap oil, and we'll see how you guys like producing it at real prices. And that's actually not a very bad distinction. So, if you want to think conventional, unconventional, be my guest. If you want to think expensive and whatever the alternative is, that's another way to think about it. But whatever you think, oil and gas from shale plays right now is profoundly non-commercial at current prices, and I think at prices somewhat elevated from what they are today. So it's kind of irrelevant. My view all along, and those of you who've heard me speak before understand my perspective here. What revolution? We've known about these plays for something like 50 or 60 years. I mean, all the major oil companies were studying them decades ago. We're not stupid. We know they got oil and gas in them. We know they're source rocks. And the trick became, or the storyline is, that we finally developed the ingenuity of combining these technologies called horizontal drilling and hydraulic fracturing to make them commercial. Well, the truth is the price got high enough that we could afford to do those things. I don't want to take anything away from the plays, but let's never forget price. And of course, most of the discussion of shale plays never talks about price, never talks about cost, talks about volumes. Isn't it wonderful that we're producing however many BCF a day and however many million barrels of oil a day that we weren't producing a few years ago? Well, yeah, that's great. But what does it cost? And are you making any money? I mean, these are, I don't know, I've been in this business a while. Seems like those are questions that my clients would like to know about rather than being impressed by the volumes. The bottom line on all this is years ago, when we didn't know very much about these plays, I said, I think the reserves are overstated. And I based that on what operators were claiming their average well reserves were. And I explained why I thought that was the case back then. Well, now we've got, anybody can look on the EIA website or a number of other sources, and you can actually see what are proven and proven undeveloped reserves and see how they change from year to year. And the 2013 proven and proven undeveloped reserves for the whole United States, including tight oil and shale gas, were published in December, and so we know the answer. And the answer on shale gas is 8 years of supply at current consumption. And again, you know, that's not cheating, it's a shorthand. I mean, that assumes that all of our supply came from shale gas, which of course it doesn't. But, you know, it's a good way of simplifying it for, you know, for people who, like me, who like simple explanations. The oil side, we got 3 years, okay? And if you actually look at what's been produced to date, for all the fanfare about shale gas, we've produced about 40 TCF, which is a ton of gas, and it works out to be about 1.5 years of supply. And on the oil side, we've produced less than a year's worth of supply. So, you know, again, not in any way to diminish the significance of these additions, because a few years ago we thought we were just running out of everything, but to put it in some context. And so, you know, this becomes, I think, important as we go forward. Both of those plays, well, they were going to peak in the next 10 years. Now, if we stop drilling them, they'll last a lot longer. So that's optimistic, right, Donna? Okay. Current policy favors export of both crude oil and natural gas based on a belief in abundance, and we'll talk about where that may come from. And whether we do that or not, you know, I'm indifferent. You know, I don't have investments that favor or disfavor. I'm not in favor of regulating. If people can raise the money to do it, then they should be allowed to do it. Personally, I think it's a really stupid idea, but you know, that's my opinion. They won't get any investments from me. But if we do, and we will, this will both hasten and accentuate the tough times that we're going to see as a country in the 2020s, sometime in the 2020s, depending on, you know, how quickly or how slowly we recover from the current downturn. So for those of you old enough, and I think there are plenty of people in this audience old enough to remember my friend Fox Mulder on the X-Files, he had this poster in his office. You know, Fox desperately wanted to believe that there were extraterrestrials and life on other planets. Well, just like Fox, I really want to believe this beautiful story. And the beautiful story has to do with energy independence and American global dominance. I mean, you know, who could fight that? I mean, that's a great story. So the story goes, production from shale is a revolution, and it's changed everything. The U.S. is now the largest producer of natural gas and petroleum liquids in the world. That's true. That sure wasn't true a few years ago. There's at least 100 years of natural gas supply. Even President Obama knows this to be true because he said it twice in 2 successive States of the Union address, along with a lot of other things that some of us may not agree with or believe to be true, and that we've got some unknown number of decades of tight oil supply. Now, BP just recently, like this week, published their outlook for, you know, the next 30 years or so, and we are assured from BP that the United States will be energy independent, so they must be right. I don't know how they get to that conclusion, but you know, I've always been an outlier. The U.S. will use its endless oil and gas resources to reassert our dominance in the world. Well, that sounds pretty good. We are going to bring Vladimir Putin to his knees tomorrow. And we're going to punish him for his aggression, which we're clearly prepared to do, as he's negotiating independence for Crimea. We're going to export our excess natural gas to Europe so they don't have to buy it from Russia, and we're going to export it to Ukraine so that they can kick Russia out. And we're also going to export our natural gas to Asia. By the way, there was a great op-ed in the Wall Street Journal by John McCain, who's probably as much of an expert on oil and gas as Alan Greenspan, who just recently published a great op-ed in the Financial Times. You know, I was talking to John Blickweed. I'm curious why they used Alan Greenspan. I mean, if they're really going for the 25 to 40 demographic, somebody like Beyonce or Dr. Dre really has a lot more appeal. I mean, Alan Greenspan's not even the Time 100, top most influential. They could have at least picked Carl Icahn. I mean, he's on the list. But so I'm thinking about writing an article on central banking. Since why not? It's fair game. Everybody can be an expert. I read a book, so I must be an expert. U.S. tight oil has transformed the U.S. economy, and that's partly true at least, and it's made us less dependent on Saudi Arabia and other people we consider to be somehow less than pleasant in the Middle East, and that is partly true. We are currently having discussions with Iran about becoming buddies. And we recognize that might alienate some of our allies in the region, like Saudi Arabia, but who needs them? Because we got enough oil. I mean, FDR was wrong that we needed Saudi oil. So we can, and these are, I'm being facetious, obviously, but I mean, this is the basis of our policy decisions in the United States, clearly. Shale gas has reinvigorated American manufacturing and petrochemical production, and that is partly true. I mean, Dow Chemical and all kinds of companies are coming back to the U.S. because it's so cheap. And by the way, those companies are all completely opposed to LNG export because they feel like it's going to screw them. But whatever. These are our policies. This makes all the difference. So, okay, so what I'm going to do now, I promised you that, I'm going to deviate from decades and kind of try to tie all this together and give you my weird perspective on what shale is about and what the current oil crisis, price crisis is about. And to do that, you kind of have to get recalibrated. And so while I threatened to write an article on central banking, I am not an expert on the economy, but I feel quite comfortable in making the statement that energy is the economy. And I'll show you plenty of slides that I think demonstrate that. But the slide right here, which is real U.S. GDP in blue and average consumer price index adjusted oil price in red, and I think you'll see, an almost perfect negative correlation. So when oil price is high, GDP sucks. And when oil price is low, GDP goes up. And, that's kind of intuitive, but, I have to make these points because so many people, particularly in policy positions, think, well, there's politics and there's football and there's energy. And they're all kind of, secular topics that we can talk about separately. And it's my belief, not just because I'm in this business, but because I actually believe it, that energy is the underlying reality that unifies certainly everything economic and an awful lot of other stuff. Currency. What is currency? Money. Money's a call on labor. That's all it is. Okay? I need you to do something for me. I need you to do some work, and I'll pay you money if you do the work. So in other words, money is just a proxy for calories. It's a proxy for joules. It's a proxy for energy. So really our whole economic system is, you get right down to it, is just a way of manipulating the energy that we have. Energy resources are the capital account that backs our currency. And I'm going to talk a little bit about Richard Nixon and how he took us off the gold standard. Well, guess what? I mean, gold was just a proxy for energy again. So, these are my beliefs. The economy can grow as long as there's a surplus of energy in that capital account. And it stops growing when there's only enough energy to meet our most basic needs. So when people try to understand why it's so hard to get the economy rolling again after the Great Recession, this is the answer. Because we're using less and less oil. We were when the price was high because we couldn't afford it. And if your GDP, if your consumption of oil is dropping 1.5% a year, and your GDP is 1 3/4%, then you're only growing 1/4, and that's not good. And there's a direct correlation.
Art, what was the left-hand date on that slide?
I don't know how to do this.
Previous.
Well,
Yeah, previous.
I shouldn't let you ask questions. That's let's see. How do we go back? There we go. The date, I believe that slide goes through, it's December of 14, possibly January 15. I mean, it's only showing you every second or third month, but these are all super current slides, okay? You'll have to trust me on that. No, they are. I just made them today. A framework for U.S. shale gas and tight oil and the current oil price crisis. Well, I recommend for anyone who either agrees with what I'm saying, thinks it's interesting, or disagrees, you ought to read The End of Normal by, what's his name? No. The End of Normal is a book on economics, and it talks tremendously about the, the current energy situation. And what the End of Normal showed me was that our whole notion of what American success and ingenuity and democracy and expansion, it's really kind of selective memory of a very short period in American history following World War II up until about 1970. And that was a period, I mean, thanks to World War II, all of our competition was dead in the water. There was no competition. Everybody's Navy, everybody's Air Force, everybody's Army was in tatters, and we never got invaded, and so we were doing great, and American manufacturing was the king, and we were the China of the time, and we had major export surpluses, and we were the leading naval power, and we ran the world. And on top of that, we were energy self-sufficient. We not only had all the energy we needed, which was oil at the time, but we had plenty of spare capacity, and we controlled world oil prices right here in the state of Texas in Austin. Texas Railroad Commission had a brilliant system of allowables that allowed the Texas Railroad Commission, with the consent of neighboring states like Oklahoma and Louisiana that followed our lead, we controlled the world's oil prices. So the United States had it made in the shade. We were the leading manufacturer, we exported crazy amounts, we had a big foreign account surplus, energy independence, and controlled the price of oil, and we had no competition. You can't hardly beat that. Well, we rebuilt Japan and Germany, and by the mid-1960s, that situation started changing. They started making transistor radios and TVs and weird stuff like that, and things weren't quite as good as they had been. And then we had this kind of quiet revolution, almost like the shale revolution. U.S. oil production peaked in 1970, and the Texas Railroad Commission said, never mind. And OPEC was formed 10 years previous, and OPEC said, okay, we'll take over this control of world oil prices. Well, 1971 rolled around, and as my business partner calls him, the Antichrist, Richard Nixon, was the president. And, the economy was really in bad shape, and this was not supposed to happen. The post-war America was always better, always bigger, always better, and all of a sudden we were having inflation and unemployment and, all kinds of crappy things were going on. And Nixon really needed to be reelected in 1972, and so he did a bunch of things. The only one that I'm going to talk about tonight is he said, we hereby abrogate the Bretton Woods Accord, which was the post-World War II agreement whereby the international currency was put on the gold standard. When I was a kid, Fort Knox was a cool place to go because every dollar bill was actually part of a reserve currency that was backed by a brick in Fort Knox. Well, Richard Nixon said, no more of that. Next thing we knew, everybody else who belonged to that Bretton Woods club said, yeah, we're out too. And in almost no time at all, oil prices increased 2.5-fold, like within a year. And within, within 5 years, oil prices, I'm talking about real oil prices, like in 2015 dollars, they had increased 5.5 times. Wow. The world and its economy would never be the same, but boy, I sure did like Ike back then. Those were good times. Well, so here's this is a very busy slide because the world is a busy place, but I don't know if I have a pointer up here or not. I probably don't, but I'll fake it. So, we got this area on the left where the U.S. dominated world manufacturing and power. Everything was great, and you see this is in 2000. This is in December. Thank you. December 2014, real dollars. Okay, so the Texas Railroad Commission was just doing a great job keeping it right in there at $20. End of the Bretton Woods agreement. Wham! A wall went up, and oil prices in real dollars went to $50. Now, we were taught in school and elsewhere to blame this on the Arab oil embargo. And the Arab oil embargo was the excuse. But what really happened here was the Arabs were getting screwed by the Texas Railroad Commission because they were artificially keeping the price of oil down real low when all this devaluation, and that's what it was, massive currency devaluation by the U.S. and the industrial powers, they said, okay, we're annoyed with what's going on in this little 6-day war between Egypt and Israel, and so we're going to impose an embargo, and that's the reason that oil prices went up. That's not the reason oil prices went up. They went up because the currency got devalued, and OPEC took advantage of that to get oil prices to where they should have been back in here when the Railroad Commission was keeping it low. Okay, so interestingly, the embargo was, I think it began in, I don't know, it was November, and it was over in March, and you see what happened to oil prices. They never went down again. Funny about that. So that's so the Antichrist did something pretty important right there, and he did it because he had to, because the American economy wasn't working out the way it was supposed to. We got a couple other things that went on here, but the main thing was this Iran-Iraq war that suddenly took oil prices up to almost $120 a barrel in 2014 dollars. Okay, so we went from 20 to 120 in a matter of just a couple of years. And if you don't think that hurt, I mean, what we're going through right now is nothing compared to that. And of course, we're going the other way. It's interesting. I hear all these experts, Dan Yergin being, it's great to be a Cold War historian and to be in the same league with Alan Greenspan at the same time. I mean, you can write an op-ed and say that Saudi Arabia is not doing its job being the swing producer. Well, this comes from the EIA, who officially says that Saudi Arabia abandoned being a swing producer in 1986, so for what it's worth. There were a lot of other things that happened here, but basically this event right here in 1974, back to our capital account, was a credit alert from the bank. 1979 was this event, sorry, this was 1974, this is 79. This is the equivalent of a credit downgrade. 2008, the great financial crisis, bankruptcy proceedings began. Okay, this is what's really going on to the United States capital account, which is net energy surplus. Okay, that's the real story according to Berman. And if you're wondering why all of a sudden this thing is up and down and crazy, it's because of that. It's because we don't have any spare energy. So what a weird thing when people come along and say, well, forget about all that, because now we got shale. It's the end of history, wipe all that off, and we're good to go forever. Well, there's an effect that we talk about economically called the choke chain. And the choke chain happens when there is the reality or the perception of net energy scarcity. Okay, so what that means is that you got too much demand for supply, and then you got too much supply for demand, and then you got a supply deficit, and then you got a supply surplus. And these things happen. This is 2008 right here, and this is the present right there. They happen about every 12 months. So, I've read infinite numbers of blogs where people say, we never saw this price downturn coming. Well, what do you guys do in your spare time? I mean, it's like every 12 months. I mean, we just had one 12 months ago and 12 months before that. Now, granted, what we're seeing right now is is a little bit exceptional, but the cyclicity is characteristic of resource scarcity. So what happens is you get a supply deficit. That allows you to increase price to the demand limit. How much will the market bear? That causes incentive for operators to overproduce. High price causes demand destruction. Since they're already drilling all those wells, we end up with a big production surplus because we're continue to produce and now demand's down. We get a price drop, producers cut back, they lay off people, they don't invest, we end up with a supply deficit, and lo and behold, we end up with a price increase and the cycle begins again. So we're always overshooting, and we get this price cycling and this demand and supply cycling. So chronic scarcity gives you a couple of outcomes. Resource costs become significant. Okay, now all the economic models that we still use don't include the cost of energy. It's brilliant, but all it is labor. You know, it's labor and production, and the cost of energy is not part of our economic models. So whether you like the Keynesians or the Chicagoans or the Austrians, you know, none of them have any, it doesn't cost anything to do anything. Now what happens with this cycling is that people, not just oil companies, they get insecure about investing because they don't know when the next downturn is going to come. And so what happens is that net scarcity persists because of uncertainty, because we don't invest. And so we almost guarantee that the price is going to go up because we're not investing in enough drilling, and when the price goes up, everybody goes mad and wants all the profit, and that's the end of that. Service costs tend to increase faster than product price. And the choke chain, this effect, is why, and I hear this all the time, and you're still welcome to ask the question, but I know someone's going to ask it, don't you think that higher price is going to result in finding more oil, and don't you think that, you know, there's some technology out there that we don't know about yet? You know, I mean, you know, yeah, we got a laser now, we can drill a well for free. You know, it's like Jeb Clampett, you know, could shoot at the ground, the oil wants to come out by itself. Well, you know, all that notwithstanding, the problem with price is that it causes demand destruction, and so it's self-limiting. And the problem with technology is it costs money. I mean, all this fracking is hugely expensive. It's part of the reason that we've got demand destruction, because these wells cost $10 million each, you know, and they produce 100 barrels a day after a couple of months. So revolution, I don't know. All right. Well, I had to talk about it eventually. You saw it coming. The end of peak oil. You know, how many people have said, "Oh, peak oil is a discredited idea"? And you know, I'm not an ideologue. I mean, I don't really care about peak oil that much. But let's see what peak oil really says. What it says is, once conventional production peaks, supply will become increasingly dependent on more expensive, lower quality sources of oil. That's peak oil. That's the whole thing. So what are those more expensive, lower quality sources of oil? Shale, deep water, and tar sands. Where has all this come from? I mean, there's your conventional production. It peaked in 1970. We had a little resurgence at Prudhoe Bay, which really falls into this category of expensive oil because it's in the damn Arctic, okay? But I didn't count it as such. And from there, at least, we have a steady decline of conventional production, and here's the big miracle of expensive oil. So, I don't know, it looks to me like peak oil's batting 1,000, folks. I mean, you know, what do I know? But that's sure the way it looks. Well, if we look at the world, that was just the United States, we see, first of all, that, you know, this unconventional oil, this expensive oil, it's sure enough to cause a supply imbalance, but it's kind of dinky, you know, compared to the bigger picture. And basically, you know, what I come up with here is we still got a peak in conventional production around 2005. So, you know, take it for what it's worth. Again, it's not an ideological point. It's just a reference point. It's a fact. Tight oil and deep water production will continue for a while, assuming that we can afford to continue to drill those wells, which means the price has to come back. And if you take any projection that, you know, any credible person does, after about the middle of the 2020s, we're hosed. I mean, you know, we just don't have another source of inexpensive oil. So what is energy and what's it worth? Well, it's not all equal. And this table here attempts to to give you some idea of how much energy you get out for every unit of energy you put in. So, you know, with Gawar or something, you put in 1 unit and you get out 100. If you go down to the global average of conventional oil fields, you get about 30 units of energy for every unit you put in. All right, you come down here to shale and tight gas, and man, you got 5 to 1. 5 to 1. Well, I mean, that's worse than solar PV at 8 to 1, and it's a whole lot worse than wind. I mean, wind is, Christ, that's a windfall at 18 to 1. Sorry, I just thought of that. So, you know, and then we talk about all this, you know, this bonanza of natural gas we got going on. You probably can't see this, but you can read it when I give you the presentation. Natural gas is way down here. It's, you know, on a volumetric basis, the energy content of, you know, like a liter or a gallon of natural gas is 0.1% a barrel of crude oil. So it really sucks. I mean, you know, it just doesn't have that much kick to it. If you spend some money and you compress it, well, you know, then, you know, you can do something better. Natural gas liquids, which by the way are something like 15% of all this great new oil that we're producing, has 65% of the energy content of a barrel of crude oil. So it's, you know, the barrels are not equal. Natural gas is less than 1%, CNG is 24%. If you spend all the money to make LNG, now you're at 60%. So, you know, a barrel is not a barrel. It's all about energy. All right, so this is what I came to talk about, supposedly. Shale gas and tight oil proven reserves. This comes straight from the EIA, okay? There's no Art Berman interpretation in here. So you can read them and weep. Basically, what all this says is the proved, developed, producing reserves as of 2013 for all these plays put together is 164 trillion cubic feet. That's 6.3 years. The proven undeveloped is 69 TCF, that's 2.7 years. You add them together, you got 234, that's 9 years. That's what we got. And the PUDs, the proven undeveloped, I mean, you know, anybody who's done reserve analyses for an accumulation you can map knows that there's some uncertainty there. For something you can't map, big uncertainty. But I'm going to give it to them all. Tight oil, we got a little bit less than 10 billion barrels, mostly in the Bakken and the Eagle Ford. At current consumption, which is about 5.5 billion barrels a year, that's 1.7 years. You know, add the PUDs into there, and you got 3.3 years. That's it, guys.
My question is, are you saying that as if we just produce that, it only lasts a year, or is it when we import and produce that?
No, that's what I said to begin with, Linda. I said, you know, I'm using a shorthand here. I'm saying if, you know, you just divide by consumption. So this is sort of like, you know, well, it's not sort of like anything. It's just it's giving you a divisor. So if this was all there was, that's how long it would last. And with natural gas, you know, we don't have a whole lot of extra. I think the total natural gas is like 330. So we've got 100 TCF that's, you know, declining like mad. And with oil, I think we've got something like 30 billion barrels of proven reserves of oil. So, you know, it's not a huge amount. So, you know, the question, and it is an honest question, if this is what people book, and I think that companies book as aggressively as they're legally able to, and maybe a little bit that they're not fully legally able to, then where do we get this idea that we got 100 years of gas and decades of tight oil? I just don't get it, you know? Am I missing something here? Because, I mean, you know, where I come from, you know, this may not be the truth, but it's pretty darn close to the truth. Somebody had to get it by, you know, a Netherlands Sewell or, you know, a Ryder Scott or you know, a DeGolyer and McNaughton, and somebody at the SEC had to say, yeah, this looks okay to me, which doesn't mean it's okay, but, you know, it's not just what somebody says, okay? And by the way, well, I'll show you that in a second here. These are the reserve additions for shale gas and tight oil in 2013, and what you can see is new field discoveries for shale gas, 16 BCF. Wow, let's have a party. I mean, there's individual wells that make 16 BCF, so we're not finding any more tight gas. All of it is what they call this new reservoir discoveries in old fields, which is still only a TCF. So, it's not huge in the scheme of things. On the oil side of things, we found 9 million barrels. Now, there isn't a major oil company in the world that would do anything but sell a 9 million barrel discovery because they can't afford to produce it. Just to put it in, I'd love to have a 9 million barrel field, by the way, okay? I'll take it every day of the week. Again, new reservoir discoveries in old fields, 170 million barrels, okay? That's a reasonable amount of oil. That's like 1.7 giant fields, okay? But, the point is that there's nothing in this data that says that we've got a gajillion years of oil and gas left in our country, at least not that I see. All right, so, we're going to bring Vladimir Putin to his knees, and we're going to, kick Saudi Arabia's ass because our dad's bigger than your dad, and we're producing more of something. Well, this is BP data. This is proven reserves of oil by country. The U.S. is a whopping 10th. Okay, now, my wife watches The Voice, and if you're 10th, you don't make it to the finals. You don't even make it to the second, you're out. And you hope that somebody signs you to open for AC/DC at the Grammys or something, or some, guys older than us. I mean, it's unbelievable, really. So we're 10th. We're 10th in oil. And this gets back to this whole business of volumes. Volumes but not cost, and rates but not reserves. So we may outproduce Saudi Arabia for 15 minutes or so, but we've got 17% of the reserves, people. I mean, we're a real lightweight compared to Saudi Arabia and Iraq and Iran and everybody else who's in between. I mean, we're close to Libya. How about that? We're less than Libya, but we're close, so that makes me feel better. On the natural gas side, we're 5th, okay? And we're a very long 5th on natural gas, I might add. The next in line is Turkmenistan. Probably half of us couldn't find Turkmenistan on a map. But we've only got 53% of Turkmenistan's natural gas reserves. By the way, they're building a pipeline to East Asia, so that's kind of significant. Next on the list is Qatar. We've got 38% of them, and when it comes to Russia and Iran, we're not even close. So we can kick Vladimir Putin's ass all we want, but he's going to kick our ass when it comes to natural gas proven reserves every day of the week. Okay, so we want to export crude oil. Lisa Murkowski and our own famous Ted Cruz, pounding the table about, okay, here is the EIA, again, no Art Berman interpretation, EIA's annual energy forecast outlook for 2014, peak of U.S. oil production in 2016. Minimum import 2016. Production declines thereafter, and imports increase. So, what am I missing? EIA is never wrong. That's the obvious. They're wrong all the time. But I give them credit because at least they make a prediction. That's more than a lot of people do. So they're probably going to revise this. But I think it gives you some calibration of what reality could be. And reality isn't decades of flush oil production that keeps on going forever and ever. I've already said that. Let's talk about shale gas. Well, here are the big plays. We got the Marcellus and the Haynesville and the Barnett and the Fayetteville and the Woodford. Well, everything but the Marcellus is already in decline, and we just discovered these damn fields a couple of years ago, right? I mean, this is 100 years of natural gas. Now, of course, they're not done. I mean, they're going to continue declining and producing something for many, many years. There's no doubt about that. But, the idea that U.S. gas production from shale keeps going up is a single bet on one play. And, most people in this room have been around long enough to know that no matter how good the play or how good the field or how good the country, I mean, you know, it does peak in some reasonable, you drill enough wells and it's going to peak, and after that it doesn't go up anymore. So, you know, again, this is the Art Berman interpretation, but it is based on what the Bureau of Economic Geology's done, what Dave Hughes and some other independent people have done. And on the Marcellus, I mean, Wood Mackenzie has a forecast that only pushes that forward about a year. So, you know, we're in the right ballpark here, I think. So the future of U.S. gas supply is a single bet, and other people see it kind of the same. So then in December, this really interesting article came out in Science called The Fracking Fallacy. You know, great title. I mean, Mason Inman is a clever journalist and a good guy. And basically what he did was he said, well, EIA has this view of natural gas, and the Bureau of Economic Geology at the University of Texas has a very different view. And of course, they've backpedaled on that a bit, but you know, that's okay. And then of course, there's David Hughes, who has this drilling deeper study. And these two guys, Bureau and David, have looked at every well in all of these plays. Every single well. I mean, this is a mammoth undertaking. I mean, EIA doesn't have any geologists. Okay, so if they've looked at every well, I don't know what they see. You know, well, I mean, seriously, you know, they're smart guys, and I respect the hell out of them. But you know, they don't have the backgrounds that we do. These guys do. I guarantee. You know, they look at samples. They look at, you know, averages of big companies. So you know, so what we got going on here is that UT, which by the way comes very close to what I'm showing here as. Well, here's 2013 proved developed plus proven produced to date plus proven undeveloped, and you can see that UT is very, very close to 2013 proven reserves. What a shock! What a shock! What's EIA got going on here? They got some magical thinking going on. I don't know what they got going on, but you know, this is the basis for all the LNG export terminal permits that have been requested. They say, well, see, this is what EIA says we got. Well, you know, here's two fairly credible third-party sources that I don't think have an investment stake in shale gas who are coming up with a real different number. So I don't know what the right answer is. Well, I showed you what I think the right answer is, but all I'm trying to show is that it's not just Art Berman who thinks there could be a problem here. There is a problem here. Well, so, you know, we've used those EIA estimates to do some things that I think are kind of silly. This chart here, the blue is the pipeline exports that we not only plan, but have already built the pipelines for to Mexico. And the red is EIA's estimate for the LNG exports that have already been sanctioned, and people are busy building expensive terminals to do so. When you add it all up, you know, we're going to be exporting 10 BCF a day just to if nothing else is approved by 2020. And what I just told you is that a few years later, we're going to be declining in our gas production. So, you know, that looks like kind of a dumb idea to me, but, you know, got to love them if they have the money. Now, the EPA at the same time has put in a bunch of regulations to force the retirements of a bunch of coal electric power generation plants, which is, you know, probably a good thing. But what's the alternative? Well, of course, it's natural gas. And the reason that they got away with this is because they said we got 100 years of natural gas or more. Well, the estimates for the plant retirements, which, by the way, go into full effect starting this year, add another 4 or 5 BCF to the 10 BCF, so now we're up to 15 BCF a day within 5 years. So, and we got more people all the time that want to export LNG and build pipelines. So the guy whose ass we're going to kick in Russia made a little deal this past summer with China called the Power of Siberia Pipeline. And the important thing about the Power of Siberia Pipeline is, first of all, Siberia is really powerful when it comes to natural gas and crude oil. And they're going to deliver gas, to the Chinese border, and a whole bunch of it, for $10 an MCF or a million BTUs. And what's really important about that, that's like $5 less than the spot price was at the time in Korea and Japan, but it's not linked to oil price. And forever and ever, LNG prices all over the world are linked to oil prices. So when crude oil prices are high, it's expensive. So here's a new threshold for everybody in the LNG business to swallow. This agreement has absolutely monumental implications. They've got a pipeline that's planned to Korea and Japan. So they're going to capture that whole East Asia, big-time natural gas market because they don't have any natural gas of their own and they don't have any oil in that part of the world. Russia plans to be the leading supplier to these markets. By the way, being nice with Iran. Iran has more gas than Russia, and makes huge sense that they're going to pipe their gas once they're back into the boys' club to India, Bangladesh, and Pakistan, who all are net importers of natural gas. So suddenly the whole Asian market just went away. And if you can't compete for $10 gas, you're SOL, you're out. Well, what's it cost? This is Royal Bank of Canada's data, and I made this slide for some Canadian audiences, and the Horn River Basin, which is their big deal, or the Montney, they're $12 to $14 because those are new plant constructions. Okay, if we move over here to our friends at Cheniere, they say they can do it for $10. Okay, well, that's so they can break even if you don't include any kind of cost of money. So basically they're losing money. So the best we can do, assuming, and this is assuming that the Henry Hub price stays the same, okay, is we got one plant in the Gulf Coast that might be able to only lose a little bit of money by exporting to Asia. I did it again. Damn. Okay. Problem is that if you believe anything that I've said, the Bureau of Economic Geology says they said but don't say anymore, or that Dave Hughes says and still says he says, we're going to be in a situation where natural gas prices have to increase because our production's going to peak. And so the question then becomes, at what price does it make more sense to can the LNG, the expensive LNG, and the big export transportation charge to Asia or Europe and just sell it domestically? And the answer is, makes all the sense in the world. So I think that the LNG business has been about, I don't know, 180 degrees isn't enough. They've been so far off the mark at every stage of the game since the 1970s that if you want investment advice that I won't be responsible for, whatever direction those guys are going in, go the opposite way. Or short them. Ironically, super ironically, LNG import into the United States in this scenario looks not only likely but inevitable. So maybe those guys will finally get their due. All right, so wrapping it up and moving along to what everybody's interested in to begin with, which hopefully links through all of this back to where I started, is the present oil price crisis. Okay, and so, what's the reason for this thing? I mean, you can read a million blogs and a million Alan Greenspans and, you name it, and they'll come up with a million different reasons. It's like, the monkeys at the typewriters in Macbeth. But, being fairly simple-minded, I would say that's the reason right there. It's U.S. and Canadian tight oil production. That's U.S. Canada's buried somewhere down here in, Libya, Norway, and a bunch of other stuff. Saudi Arabia has actually decreased their production a little bit. So, the cause for our pain right now is us. Okay? It's the cowboys in charge of that whole demand cycle. Oh boy, prices are high. Let's drill a whole bunch of wells, and let's push the price higher and higher and higher. And we have, we're producing 1 million barrels a day extra every year. And we finally tip the scales. and now we're paying the price. And you got all these CEOs, you know, Scott Sheffield over at Pioneer, and, you know, they're pissed. You know, damn it. I mean, you know, why isn't Saudi Arabia doing what they're supposed to do and save us so we can continue to make money by overproducing? And, you know, people, you know, it's like Saudi Arabia is, you know, they're irrational. I don't know. I mean, if I were Saudi Arabia, I wouldn't want to cut my production and lose money so you guys can produce more and make money so I lose more. I mean, that doesn't make any sense. And I'm not a great fan of Saudi Arabia, I'll tell you, but you know, that's the way I see it. So basically what happened is the choke chain effect ended this current price cycle in mid-2014. It's just overproduction. Now, there's a demand side, absolutely, demand destruction, remember I talked about that. The world economy stinks, and you know, that's another piece of it, so I don't want to oversimplify this. I'm just making it easier, and I will talk a bit before I leave. So what's going to happen? The current slump is going to slow production and increase demand because of low prices. By the way, you know, miles driven in the United States is surging like crazy because you can fill up your tank for under $50, and you know, everybody's thrilled except for those that are on Facebook too much to know the difference and don't drive anyway because they don't work. So, you know, let's really think about this deal. I mean, what have we really done? Tight oil and shale gas plays. They were funded by debt, bonds, stock offerings, and asset sales. So what we're looking at here, I've taken Bernstein's 48 or 49 E&P companies that represent 40% of U.S. oil and gas production, divided them into gas-weighted companies and oil-weighted companies, and what I've taken, this is third quarter results. We'll have full year results here, you know, momentarily. So these guys, the gas guys, cumulatively out of the 23 or 24, had negative $6.6 billion in free cash flow. So they, you know, they're losing $6 billion. So and their ratio is something like, you know, $1.20. So they're spending $1.20 for every dollar that they have. The oil guys are worse. They got $7.6 billion in negative cash flow. Together, they got that's in 1 year, $14 billion of negative cash flow. Now, please tell me how this is a success. Again, this is not Art Berman's interpretation. Anybody who cares to can get on Google Finance or Yahoo Finance, and you can go through the pain in the ass process that I did and look up every company on this list and write down or put in Excel their free cash flow and their debt and all that kind of stuff, and you're going to come up with the same answer because this is the truth. So the success is not financial. Okay, and I'm not going to say that there are no companies that make money here, okay? I mean, there are a few. I mean, EOG has got a slightly cash flow positive. Companies like Southwestern Energy are cash flow neutral. I mean, so, you know, some of these companies, because they have a good position or they didn't pay too much to get in, but, you know, it's not real spectacular. I mean, it's not like you'd want to pound the table and, you know, talk about 80% internal rates of return. It's like we're making no money. So my financial advisor comes to me and says, all right, I got a really good investment for you. You'll make no money, but you'll get all your money back. And of course, after you count in the, you know, inflation or CPI, you'll actually lose money. What do you think? I said, get out of here. You know, I'll fire you. Well, you know, that's what's being sold. Okay, so the companies are chronically cash flow negative. They have unmanageable debt, okay? I mean, I'm showing the debt. This laser pointer must be funded by Shale. So, you know, we got, you know, this gigantic $173 billion of debt among, you know, 40 some odd companies. I mean, that's that's more than the debt of, you know, continents in some places. And so what's the likelihood? I mean, you know, okay, everybody in here's got it, you know, had a few math classes. If you got negative cash flow, that means you'll never pay it off. Ever. Ever. So what is a company that continues to increase its debt, continues to increase its spending, and can never pay it off? It's a Ponzi scheme. By definition, I've never said that in public. But I will say it now because that's what it is. The only way out of your financial arrangements is to refinance at an increasingly worse rate. So that may not be the classic definition of a Ponzi scheme, but pretty close for me. So you got unmanageable debt that can never be repaid from cash flow, got to continually refinance on increasingly poorer terms, diminishing returns on investments. So here is, this is International Energy Agency, and they're just showing here oil and gas investments, an increase in total liquids production. So, here we went ahead and we spent some ungodly amount of money, and we barely added any oil production. So, we spent $700 billion, $690 billion, and we ended up, increasing our oil production by, 6 million a day. So we're not doing real great, and that's not our fault. I mean, that's because of what I showed you, that we're not making more of this stuff, and we're not finding giant fields anymore. So the E&P business has become financialized, and I'll explain a little bit more what I mean by that. But the only real measure is production growth. Doesn't matter, obviously it doesn't matter what these financials are. People would have been, running for the doors a long time ago. The appeal, and I get it, the appeal is we got no other plays that have big reserves, so these are what we got. The other appeal is it doesn't take us 15 years like Kashagan, to develop. I mean, we can go out and drill a well tomorrow in the Eagle Ford or the Bakken or, whatever play you want. And, we can claim great return on investment because the reserves come down the road, and maybe they're real and maybe they're not. But these are the kind of things that companies like, and after all, they have to have, okay? So if your opportunities are diminished to this, then this is what you have to do. And I understand that. I'm not opposed to that at all. So the current oil crisis, well, it's caused by us. It's caused by the shale players on the oil side principally. This is the data. This is EIA. IEA doesn't look very much different except that it's quarterly, and EIA gives me monthly. The red is consumption and the blue is production. So what we see here pretty clearly is that for all of 2014, with the exception of 1 month in July, production exceeded consumption. And when production exceeds consumption, you got a problem, okay? These are the actual numbers, and I don't expect you to really care too much. I've actually got Brent price down here. And what we see is that in 2013, we actually had a production deficit of, a half to 1 million barrels a day, a little bit over 1 million in November. Beginning in January, it changed to a surplus, okay? And for all of 2014 and so far into 15, we got more oil than we want to use, and that's just that simple. The price signal is typically lagged by 6 months. We can't believe it. It must be a fluke. We'll wait for another month of data, and then we'll find out. Well, now it's real, okay? And so what is the surplus? Well, we're talking about 1 million to 1.5 million barrels a day. I mean, it's not that much. I mean, it's a fairly ordinary production surplus. So the question then becomes, why is it kicking the shit out of us? Because that's what it's doing. And the answer is, I think, it is the financialization of the exploration and production business. Okay, what does that mean? That means that E&P companies have become, not all of them, but many of them, have become subprime, securitized investment vehicles. And I'll get to what that really means in a minute. So this is the federal funds rate, okay? So here we are in early 2000, and it's up around 6.5%, went down. Here's the financial crisis, it's up here. And then financial crisis really takes hold, and we got interest rates at zero, effectively zero, since 2008. I'm also showing CPI adjusted West Texas Intermediate, and what it shows is that when interest rates can kind of do what they want, and oil prices can kind of do what they want, they sort of move in conjunction. Okay, but we've messed with interest rates. We've forced them to be almost zero for now 7 years, And yet oil prices still fluctuate around because of supply-demand imbalances, little problems, like Libya and the Arab Spring and God knows what else. So what happened is, if you're in a zero investment world, where can you get a return? Where can you get a yield? I mean, you put it in the bank and you make, 0.5%. You put it in a CD for 20 years or a treasury note and you get 3/4. Well, that's not good enough. That's not good enough. We got to have more. So investment banks are good at finding more. And investment banks, and there's a lot of money in the world, tons of money in the world, particularly petrodollars in the Middle East, because they're getting $110 a barrel. So investment banks identified the U.S. E&P solution business as the solution to where can you get reasonably secure, respectable yields in a zero interest rate world. And how do you do that? Well, you buy corporate junk bonds. That's how you do it. That's one good way to do it. Or you just loan them money outright, or they offer stock. And in many cases, they'll offer preferred stock, which means if they go bankrupt, you're first in line, and they pay a coupon. And what are those interest rates and coupons? They're like 6 to 10% interest. Now, I'm not a brilliant investor, but I suspect that some of you are. And if you could get a reasonably secure 6 to 10% yield in today's market, I think you'd all be running for the phones or Twitter or something, because that's really good. So, I completely understand this. I mean, this makes great sense because it's in the United States. We're not going to have a revolution probably. We got fairly straightforward fiscal terms and tax laws and supposed rule of law and all kinds of things that, make investors feel good. And, maybe the company's going to go belly up, but, there's a hard asset in the ground. I mean, it's oil, it's gas, and it's the United States. And if the company goes bankrupt, somebody's going to buy them. It's not going to go away. So this, and it really is. It's a pretty good alternative to putting it in a savings account. So E&P companies have become the subprime derivative, the securitized mortgage of 2008 to 2015 in the post-financial crisis period. And it's all been made possible by this. Okay, so, I mean, you can read articles in Bloomberg's and elsewhere. I mean, the amount of capital that has flowed into this industry is astronomical. It's infinite. I mean, the production may not be infinite, but the money is. The money has been absolutely endless. Private equity, I mean, you name it. So these guys have had an endless amount of money to drill an endless amount of wells, and they don't have any performance requirement other than one. And that is that every one of these companies has what's called a debt covenant or a loan covenant. And what happens there is if your net asset value drops below a threshold, then your creditors can call your loan. That's what happened to Bear Stearns. Okay, Bear Stearns wasn't out of money, but their net asset value, because everybody sold their stock overnight, it went down to a level that was below the threshold of their loan covenants, and they didn't have the cash to perpetuate those loan covenants. Okay, so everybody's got to stay above that. When Chesapeake almost went under a couple of years ago, Aubrey's roommate from Duke somehow miraculously arranged a bridge loan to Chesapeake to stay above that level while they sold assets so they could equalize the thing in a couple of months. That's how it works. Okay, so that's what's going on. So in conclusion, this is the same graph except it goes back to 1954, which is as far back as I've got data on federal funds and other things. And so what we see, again, back to the Texas Railroad Commission, interest rates were doing all kinds of wild stuff, but the Texas Railroad Commission was keeping oil prices low. When they let go of the controls, what happened? Oil prices went up 2.5 times in 1 year and 5.5 times in the next 3 or 4 years. Okay, so the system equilibrated. That's what happened. You want to mess with the system. Energy is the economy. You want to mess with the economy either by oil price or interest rates or something like that, and you're going to pay a price down the road. Okay, so at that point, so here's the big price increase in 1974. There's the 1979 big increase. Okay, and then Paul Volcker let interest rates go to 18%, and that caused a worldwide depression to all the countries that were indebted to U.S. commercial banks, which were many. Demand was low for a long time, prices sucked, and so we finally get things going again. Financial crisis hits, and all of a sudden we're back to pre-1974, only this time we're not controlling oil price, we're controlling interest rates. And the result is what we have today. So basically what's happened is, I think, that the financialization of the E&P business in the U.S. created an unprecedented boom in production and economic activity that had no reference or calibration to its lack of commercial substance. Doesn't matter if you're making money because we give you more. Drill more wells because we like what you're doing. Energy is the economy. And just as energy prices reacted to this peculiarity or this manipulation before 74, that's what's happening today because of the low cost of capital. So the beautiful story of shale plays, all fairy tales have some truth. You wake up on Christmas morning and there really are presents, and the cookies are half eaten, and there's reason to believe. And remember, I want to believe, okay? So, and we all do believe. You can't perpetuate a complete myth. You can't perpetuate a total falsehood. But the beautiful story was part truth and part fiction, as any story has to be believed. The reserves added were important. We needed them. We still need them. But they're not revolutionary. They added years, not decades. Maybe decades now if we go into a big recession forever. The U.S. is a major oil and gas producer, but we're a lightweight when it comes to reserves, or welterweight, I guess would be a good way to put it. In my opinion, neither crude oil or natural gas exports make good sense because we don't have enough to be able to afford to send it to someone else, but we probably will. The current oil price crisis is normal from the standpoint that I've tried to develop here, which is of supply surplus being part of a predictable pattern of price cycling that comes from resource scarcity, which I hate to tell you is what we got. And the problem is that its severity and duration are uncertain because it represents the culmination of almost a decade of monetary meddling and unprecedented capital availability and the unbelievable production surplus that has been created in North America as a result. So I don't know if that's optimistic or not. The good news here is that this production will drop off very fast once we turn off the money, and the money's been turned off. How fast will it happen? No one knows. I put an article out there a week ago, which is probably aggressive. I can show you the calculations, and they're not impossible. We could be off 500,000 barrels or so by June. Other people, just on the way here, a friend of mine called me and said, "You're crazy. That can't happen. We've modeled it." Well, okay. People said I was crazy 6 or 7 years ago when I said shale gas reserves were overstated, and maybe I was closer to right than some people thought. So thanks very much for your time and attention, and I'll take questions if anybody can stand to stay any longer. Thanks. Scott.
So the big question is, what happens as the price starts to slowly ease back up?
Okay.
We can only answer it as a strategic or global question, but some of these companies that are so far underwater at the moment are gradually going to come out from under this as the price starts to boost.
Okay, so Scott's question is, what happens as price starts to recover? And so the assumption there is that price will recover, and I believe it will.
Oh, it will.
And the question then is when, and the answer is no one knows, but I'm optimistic that by the end of this year, I think we'll probably be seeing, something in the $70 range, perhaps. Again, I could be way wrong. Price is not I'm not an expert on price, and I don't like to make those predictions, but that's, I mean, Mattress Mac won't be wrong. Okay? He's a smart guy, and he's got, probably asked somebody other than Alan Greenspan, and probably didn't call Beyonce or Dr. Dre either. So, but here's the problem, Scott. The problem is that these companies were in big trouble at $95 oil. Okay, so we're going to see 10Ks, we're going to see full year financial results. We're already seeing it from some companies, but we're going to see them all in the next month or two. Okay, well, what's that going to tell us? Well, the average price for fourth quarter was low, but doesn't begin to reflect how low it is now. So it's really going to be first quarter of 2015 that's going to show just how deeply troubled some of these companies are, and we're not going to see that until mid-year. My guess is that a lot of these companies are toast, and how that gets dealt with is beyond my pay grade for sure. But it's I don't think that I don't see that there's a nice easy solution to this. Just like there was not a nice easy solution to the financial crisis. Okay. You can only turn so many dials and levers, and if the underlying fundamentals are unhealthy, it takes a long time to get back. But I am optimistic. I think that this crazy amount of production will go way down. If I'm right, and we go down 500,000 barrels by June, if Russia this time agrees with OPEC and says, yeah, we'll cut, we're hurting enough, it could be over reasonably soon. I mean, if OPEC plus Russia cut 1.5 million and we're down, say, a half or a quarter or whatever the right number is, that's more than the excess that we see. So barring, some additional faltering of demand, which is always a worry in a weak economy, this could end up being a relatively normal cycle. Now, bear in mind that the 2008 gigantic downturn, within a year we were back to regular oil prices. OPEC cut 4.2 million barrels a day. Okay, so we like to curse OPEC, but they sure saved our asses in 2009, because if they hadn't, then oil prices, well, maybe we would have thanked them, because this tight oil boom wouldn't have happened. Yes, sir.
Yeah. I started working for Shell Oil in 1984. At that point, they had about 13 years of proved developed reserve, 13 years. 30 years later, they still have 13 years of proved developed reserves, and we know how that happened. So your 7 years of proved reserves for the shale, why do you think that can't keep rolling along as oil and gas companies keep developing new reserves and keeping a certain level of proved reserves based on their capital expenditures?
Excellent point, and fair enough question. So the question is, we always seem to have the same amount of reserves in the world, and it keeps rolling forward. What's different is that if we're just talking about tight oil, the presumption is that we're going to discover another Bakken or another Eagle Ford. And while we may, we don't see it yet. And again, we're back to this issue. You work for Shell. Shell studied all of these source rock plays over and over again for decades. So, it's not like we don't know very much about them. And so is there another Bakken out there? Maybe. But we don't know about it today. Now, EOG is working on a play up in, Walker, Madison counties. It's a Buddha play. And based on the size of the plants and the pipelines that are being built up there, that could easily be a couple 100,000 barrel a day play. Does that affect this calculus? Not very much. I mean, it's better than nothing, okay? But we're not talking Bakken, Eagle Ford, Permian. I mean, we're in the 1.1 to 1.8 million barrels a day. So, I don't want to be pessimistic. I just need to say that the likelihood in the most mature petroleum province of the world of finding another play as good as the Bakken, the Eagle Ford, or the Permian is about as likely as finding another Prudhoe Bay or another East Texas. Statistically, it's unlikely. It's not impossible, but it's unlikely. So that's the problem. And so your experience at Shell and the experience of the world is in a world of non-finite resources, you can always find more. And at some price, as long as it doesn't kill demand, you're going to go there. And we went there in West Africa and the Gulf of Mexico. That those deep water plays, while considerably more expensive than normal conventional production, were within the carrying cost of the buyers of global oil. Okay, so that's the. But now we're done. I mean, again, will there be no more deep water discoveries of significance or no more deep water provinces? Well, there's a province developing north of Angola and in that area off there. But I think we've pretty well maxed out our expectations from West Africa, from Gulf of Mexico, and we're just not finding big deep water reserves outside of the Atlantic margin for geologically understandable reasons. So I think as we go farther along into what's commercially feasible and what the market can bear, what the carrying costs are, the options become less. So you're right, keep that thought in mind. There are a million ways I could be wrong, a million ways. I don't, my first slide had a crystal ball on it, and I don't have access to the future. What I do is I describe the present. And the present looks like this, and it could be different, but the probability is low. Yeah. Let's take an analogy. All right, I'm 64. I'm 64, just 64. It's hard to speak up, especially after an hour of talking. All right, and so, somebody comes along and tells me that I can live to be 400. And they got this really cool technology that's new, and somebody tried it, and they're still alive at 110. And my answer to that question is, anything's possible, Tom. There've been human beings on Earth for, we got history that goes back 10,000 years. I think we kind of got a statistical range for the lifespan of a human being. Okay, and it's probably not 400 years. Medical science keeps moving. We're still under 100 years. Now your grandmother's homestead in the Bakken. There's all. I mean, the oil fields are full of this stuff. I mean, there's somebody drilled a well in the Gulf of Mexico 30 years ago with 3D seismic. Somebody drilled a well that was almost a twin, and they discovered a field. The question, and this is always the question. And this is the reality check. Yeah, there's always some cool new technology. What does it cost? What's your unit cost? Does your unit cost go down, stay the same, or go up? And the history of fracking and horizontal drilling is that it always goes up. Now, in our business, and most of the people in this room have lived through it, there is no doubt in my mind, none, that the most significant technological advance of oil and gas exploration and production after the rotary bit was 3D seismic. 3D seismic has done zero to arrest the decline of production in the United States. Zero. And I can show you the graphs. That's not an indictment of 3D seismic. I love it. I wouldn't drill a well without it. The problem is that the technology costs money, it takes time, and what it does more than find more oil is reduce risk. Okay, so if your expectation is that a technology is, so the next question is, what are the total reserves of those 3 wells? And my guess is that, maybe a couple of million barrels. They don't move the needle in the scheme of what I'm talking about here. We're talking about a country that consumes 5.5 billion barrels of oil per year. Okay, so, you know, guys like me and guys like you, you know, we can go out and discover a 5 million barrel oil field and we're rich for the rest of our lives. It doesn't make a damn bit of difference to the United States of America. It's not significant. So I don't want to dismiss what you're saying. These questions all the time, and I'll leave you with a question that I have. My last transatlantic flight, which was just over a month ago. Okay, I got on this airplane, and this airplane was so old that there was no place to plug my laptop in first class, and there were no video screens. I mean, there was one way down the aisle somewhere, you know, that you couldn't see, because the airplane was 40 years old. Okay. So the issue isn't, is there not more modern technology, because there was 40 years ago, and there certainly is today. The reason I'm riding on a 40-year-old plane without an electric outlet and a video screen is because it still works. And the technology costs too much to replace it, and we don't have the money because we're out of net energy surplus. So you want to do all these cool things. You know, that company that drilled those wells on your grandmother's homestead, I guarantee you, is one of these Ponzi scheme companies that was using your money to do it. They couldn't afford to do it themselves, and they got negative cash flow that they'll never pay their way out of. So they, you know, you tell me what it costs. I'll write you a check for whatever amount of money that technology costs, because it isn't my money, and I'm not going to pay it back. So, you know, I'm making an extreme case here to make a point, and the point is that you don't get to just say, you know, somebody didn't find anything and now they found $30,000 a month. What does it cost? What are the reserves and what are the economics? Does it make any sense? And volumes alone don't make any sense.
It needs about $50 oil to be profitable.
You're sure of that?
Yeah.
You've done the decline curve analysis and the economics,
I saw an economic report a couple of years ago.
and you believe it.
Overplayed.
You know, I can't get inside Rex Tillerson's head, and it's a good head, by the way. But I'll tell you what I think about his company and companies like his, and that is that they're in liquidation mode, and they are understandably terrified that the investing public is going to figure that out. Okay, they haven't been able to replace reserves forever, except through schemes like buying XTO that saved their bacon for 1 year. Okay, they were going to have the worst year for reserve replacement in Exxon history, except they bought XTO, and you might remember they did it right at the end of the year. Interesting timing on that. So they got 1 year of the benefit of that reserve replacement. So, you know, you read a report like BP's, and I respect BP, I really do. I mean, technically they're excellent. But yeah, you read this report and you say, who are you trying to kid here, guys? I mean, do you really believe this crap? I mean, this is pure propaganda. Well, why is it propaganda? Well, I mean, BP's a good company, but you know they don't spend the staff's time and money to do this as a public service. I mean, it's part of their marketing. You know, I download it, I read it. You know, maybe other people in this room do. You know, Citicorp and Deutsche Bank and Credit Suisse and all these guys. I mean, you know, they don't have research departments for the public benefit. They produce these reports to benefit their business. So, you know, you got to read them understanding that. It's like, you know, you call me and you say, hey, Art, I got, you know, a big contract I'd like you to take. You know, do you think you can do it? Man, there's no one better. I mean, you know, even if I don't even know what you're talking about, I'm going to tell you I'm pretty good at that. Because that's what we do. I mean, you know, and that's what they're doing. And I'm not faulting them for it. I'm just saying, you know, be careful what you read. Ask yourself the question. I mean, why are they doing this? Why are they reporting this? So Exxon and, you know, I don't know what they're doing, but I mean, they're in trouble. they're not in as much trouble as Goodrich Petroleum or, Halcon Resources. I mean, they haven't hitched their whole future to the Tuscaloosa Marine Shale or some kind of crap like that. But and they do have a positive balance sheet, and they're okay for a while. But they're looking at the future, and they're saying, geez, what are we going to do next? And so they've got to, it's the Charles Prince famous quote. He was the CEO of Citicorp, and he was asked, well, why have you decided to go into this subprime mortgage business when you've said all along that you think it's a dumb idea and it's too risky? And his answer was, because when you go to a dance and the music's playing, you got to dance. Okay, so that's the answer I'll give you. I think these guys want to shut it down, so I'll be here later.
Basically, his talk is concluded. If you have any more questions, feel free to come up here. The meeting is adjourned.